Hello there, welcome to this edition of Global Business Africa. Over the next 30 minutes, we'll be making a speed run through all the key business news stories you need to know about from across the African continent, with everything from a look at agricultural output to whether or not private capital can solve water infrastructure problems. There's plenty of that coming up. Here's what we have lined up in the program. There's a mystery infection that is decimating Kenya's maize harvest. We'll have the details. We'll be sampling reactions and analysis to South Africa's medium-term budget statement. And TI says many countries are not doing enough to tackle corruption. We'll be live in Washington with some answers. Let's start in East Africa tonight, where an outbreak of maize lethal necrosis disease. It's a bit of a mouthful, but it is in Kenya, and it might cut output by almost 30% this year as yields fall and growers abandon the grain for other crops altogether. According to Kenya's Cereal Growers Association, as many as 70% of farmers say their crops have been affected by the virus. The industry body expects production for the year ending mid-2015 to drop by about a third. Most maize varieties grown in Kenya are susceptible to this disease, and controlling methods like burning and cutting infected plants doesn't stop it from spreading. According to the U.S. Foreign Agriculture Service, Kenya produced about 2.8 million metric tons of maize in the season that ended in June 2014. It had forecasts that this year's harvest would be the same, but that, of course, was well before the outbreak occurred. From a wider perspective, however, there's some good news coming out of Zambia. The country has recorded the highest ever maize harvest on record, and now it plans to export over 800,000 tons of the grain to neighboring countries. Agriculture Minister Wilbur Simusa said that Zambia bought more than double its strategic reserves of maize from farmers and now actually has a surplus on its hands. The country has been producing bumper harvests season after season, and in the latest one, production rose by nearly a third to 3.3 million tons from 2.5 million in the previous growing season. Simusa said they have more than 300,000 tons in carryover stock. Let's move on to South Africa, with growth this year forecast at just 1.4%. South Africa will not only record the lowest growth among members of the Southern African Development Community, it will also lag well behind the rest of sub-Saharan Africa. Africa's second biggest economy is still struggling to shake off the effects of the financial crisis. But now the country's new finance minister is confident that South Africa can weather the storm, albeit, of course, at a price. He delivered his maiden budget speech to Parliament on Wednesday, and Sumitra Naidu was there.
With the South African economy under enormous pressure, all eyes were on the budget as a preview of what to expect over the next 3 years. One analyst summed it up as more pain as Finance Minister Nhlanhla Nene announced spending cuts and possible tax increases.
We have to swallow this painful medicine to really get to the point where we know that we will have sustainable public finances, and sustainable public finances is the prerequisite to do something about South Africa's developmental issues.
We need to be very careful about giving it too much of a glowing reception as yet. There's a lot to do, a lot to deliver on, a lot of promises made, a lot of talk of accountability and efficiencies and productivities. Is all the good stuff. It's what we want to hear, but now we need to see it in action.
The minister was frank about labour tensions and its impact on the economy.
He has given very clear indication that the wage bill cannot continue to grow in the way that it's been growing, and that any wage increases are going to be capped at around the inflation mark. We've already heard from the unions that they're looking for increases in the order of 15%. So it's welcome news that he's going to try and keep it to inflation. In practical reality, let's see if that's achievable.
Many were disappointed with the insistence to hold on to state-owned entities. Almost all of the state's entities are struggling financially and often look to government for bailouts. The minister announced that government may have to raise more money to fund Eskom.
It's an unnecessary burden, I believe, that government is taking on. I think we should be raising tariffs more than they're being raised at the moment. It may be unpopular, but it would restore the financial stability at Eskom in a far more rapid and sustainable way. They've also spoken about potentially liquidating some of their shareholding, state shareholding, in state-owned enterprises that are not strategic. So you would imagine the sale of shares in Vodacom, sale of shares in Telkom. Those could raise something in the order of 30 to 35 billion.
Nene projected a firm stance on the need for more efficiency, a crackdown on corruption and less spending. But many believe the speech was really aimed at keeping the ratings agencies at bay. With a possible downgrade expected before the year ends, it remains to be seen if the minister will succeed.
We have flagged certain scenarios whereby the rating could indeed come under pressure again, and one would be, again, further weakness in growth, again, prolonged labor unrest and strikes, unsustainable pay increases.
It's going to be a tough road ahead for South Africans, but many are confident that the new finance minister will be able to turn this economy around. Sumitra Nadu, CCTV, Johannesburg.
Let's make a quick run through equity markets here for you, see exactly what they have been doing across the board. Some interesting numbers coming out of the Nairobi Securities Exchange. The energy companies were reporting the results in the last 48 hours or so. Kengen, of course, reporting its pre-tax profits for the full year today, up about 3.3% to $47.16 million. The interesting bit, however, is that the main company that actually buys the power, KPLC, reported its full year results yesterday, and pre-tax profits are up 55.2%. Not exactly what exactly drove those numbers is something we'll keep a close eye on for you in future. Funding for water and sanitation using private capital in East Africa is in focus after the break. And why is Islamic banking gaining ground in South Africa? We'll have some analysis from that end of the continent. Africa is on the move. It's home to 7 of the world's 10 fastest growing economies. We help you make sense of the fast changing African business landscape. We take you where the business is happening.
We do know that the strike isn't anywhere near close to coming to an end either. That means that those workers are going to sink even further into poverty.
Welcome back to the program. You're still watching Global Business Africa. Now, the global non-profit Water.org has announced plans to invest about $2 million in water credit programs over the next 1 year to boost access to safe water and sanitation services in Kenya and Uganda. Water Credit is a program that uses microfinance to connect financial institutions to communities in developing countries that need clean water and toilets. Now, small loans, usually of about $100 or so, are then made to individuals and households. By the end of August this year, the organization had invested over $9.7 million in such programs right across the world. Now, let's study that particular story. In Kenya, diseases linked to water supply, sanitation and hygiene are the top cause of hospitalization and death of children under 5, and well over 50% of hospital visits right across the country. Now, despite a steep rise in government spending on water and sanitation, over 19 million Kenyans still lack access to improved sanitation and water supply. Closing that gap, however, isn't just a public job. You need private capital. Now, Water.org is one of the firms in that sector. It's providing microloans at interest rates of about 20% or so to help low-income households invest in better water access. Earlier on, I spoke to its CEO, Gary White. Our conversation started by me asking him where he gets the capital for this business model and at what cost.
Well, the basic capital to jumpstart this with our microfinance partners to do what we call the smart subsidy. What we need is philanthropic capital that we raise through donors that then help us pay some of these startup costs through these microfinance partners. They have to do market research, they have to hire the right staff, they have to kind of set up the M&E systems to make sure that the projects are having the intended outputs. And so we use philanthropic capital, and for instance here in Kenya and Uganda, we had a grant that we're almost in the last year of with the MasterCard Foundation. And you know, in India it was the PepsiCo Foundation, in Indonesia the Caterpillar Foundation. So we've had a really good mix of kind of corporate philanthropy that comes in. Once that goes into our microfinance partners, then they can then go source commercial capital to actually build the loan portfolios for these water and toilet loans. And that commercial capital is huge because that's the capital that we no longer have to raise from charity.
Absolutely, but it's also, well, not patient capital, for lack of a better word. So how long will it take before we get to a point where the water credit program is entirely self-sustaining based on the income that it gets from the loans that it's given out?
So in some of the earlier programs in India with some of our partners, it's already reached that viability stage where they don't have to be dependent upon the smart subsidy anymore. And one of the ways that we're helping them bridge to that ultimate sustainability is that sometimes there's still dislocations in the market with respect to sourcing capital for these portfolios. So you'll basically see, you know, mispriced risk in some of these markets where they borrow. And so what we're doing and what we've just launched recently is called our Water Credit Investment Fund. So it's actually an equity fund based in the United States where social impact investors can put in a minimum of $1 million and they then get an equity stake. And the targeted financial return to them is 2%, but obviously a huge social return. We in turn take that capital and then lend it to our microfinance partners who are having a challenging time getting capital priced at the right price.
How do we get this up to scale? Because yes, Africa's population is growing fairly fast. Government tax revenues aren't keeping pace with the infrastructure requirements. So obviously there's quite a bit of space for private capital to come into the picture. Can this model of yours be scaled up into something that you can roll out across 50 plus sub-Saharan countries?
I believe so. I think that there's always going to be a segment of the market that could benefit by getting access to the right financial tools in order to secure the water and sanitation services that they want the most. Now there's always going to be some at the absolute base of the pyramid that maybe aren't even operating in a cash economy, in rural areas in particular. They're going to continue to need some kind of support, subsidy from either NGOs or government. But just think, if you could reach hundreds of millions of people with the financial tools so that they could solve this through their own means, how much more philanthropy could be redirected to those in that segment of the market that really needs it.
Part of my conversation with Gary White a little earlier. Now, the world's top exporters are breaking their pledge to fight corruption in global trade, with well over half of the countries that signed up to an anti-bribery convention failing to implement it. That's according to an annual review by Transparency International in a report released early on Thursday. The watchdog named Japan, the Netherlands, Greece, Russia and Brazil as among the worst offenders on record. TI says graft in trade is undermining global development as contracts do not go to the best suppliers. Prices are being inflated in order to cover up for bribe payments, environmental requirements not being enforced and taxes are not being collected. To tackle this problem, the Organization for Economic Cooperation and Development, OECD, adopted the Convention on Combating Bribery on Foreign Public Officials in International Business Transactions in 1997. Now, that was widely seen as a vital instrument in the drive to curb global corruption. The treaty requires signatory countries to make foreign bribery a crime for which individuals and enterprises can be held liable. However, the 41 signatories, 22 have done little or nothing at all to enforce the treaty, according to TI. Now then, let's get the details from Daniel Rangers, who's been studying TI's report in detail. Is live in Washington, D.C. right now with a lot more data. Daniel, over a decade after it was created, why are there only 4 countries, according to TI's methodology, that are classified as having active enforcement of this convention?
Rama, companies want to make money, and when they perceive there to be opportunities in countries where there is bribery, they are sometimes willing to do that. And when the risks of not doing it are small, or indeed there is no risk of criminal prosecution from their own governments, then they will be more incentivized to do so. either to get new contracts or to maintain current ones. So at the end of the day, if the incentives aren't there to do the right thing, they won't do it.
Indeed. TI's report also did call for more input from countries where such bribery does take place in terms of investigation and prosecution. Why hasn't there been more emphasis on this particular angle before?
Well, the big picture here is, frankly, lots of places in the United States, the UK, Great Britain, the Netherlands, Brazil, lots of these places, they say to themselves, well, these are countries where, frankly, the corruption is so large, the rule of law is not there, therefore we have to play by that game. So the Transparency International's whole game has been trying to point out the hypocrisy of that, because if you don't have somebody willing to bribe, then you don't have if you don't have someone willing to pay the bribes, then you don't have the incentive there. So they have been focused like a laser beam on trying to incentivize major exporting countries to change their ways. Having said that, they are pivoting towards some of these developing countries in order to say to them, well, if large fines are being levied on countries and they are doing their job in terms of rooting out corruption, then some of that fine money should go back to the countries where the damage is done. So they're basically trying to get these developing countries to think about how that might be done, how you might implement a system where some of the fines, the large fines that are levied on major companies here in the United States, for example, could be used to do more development work and benefit those poor individuals who really are at the brunt of corruption.
Indeed. Let's focus on mutual legal assistance. This has often been problematic, especially in other instances like Egypt's efforts, for example, to recover assets that were illicitly acquired by the former president Hosni Mubarak and his allies. How big a problem is this in efforts to tackle cross-border graft?
Well, they have a colloquial phrase here in the United States. It's called, it's like herding cats. In other words, you have lots of jurisdictions, you have lots of different political incentives. In Egypt, for example, there's a slight lack of incentive now to investigate deeply into the corruption of the Mubarak era. On the side of the UK, where many of these assets are laid, there's a lack of incentive for the UK to really try to root out or freeze the assets of the Mubarak era. Transparency International is particularly critical of the UK for that. And then, you know, you have a place like Switzerland, which has a massive reputation for hiding the money of developing countries, actually coming forward and saying they want to cooperate hard on trying to freeze the assets of Mubarak and return them to that country. So you have different legal jurisdictions. People in those countries have different motivations. You have a big mess, and even the banks themselves are disincentivized from cooperating because they have all that money sitting in the accounts.
Indeed, herding cats is a fairly interesting way of putting it. We'll have to leave it there for the time being. That's Daniel Rangers live in Washington, D.C. We'll have more details, of course, on TI's reports later on in subsequent bulletins. Let's talk about Islamic banking now. It's growing fairly rapidly in South Africa. Just a few weeks ago, the country, in fact, did issue its first Sharia-compliant bond. It's due to mature in 2020. It's got a face value of $500 million. South Africa issued that Sukuk bond to broaden its investor base and to also set a benchmark for state-owned firms that might be needing diversified sources of funding for infrastructure development. Sumitra Naidu has more in What's Hot tonight.
South Africa has become only the third non-Muslim country in the world to issue an Islamic bond. The Sukuk al-Ijara is also the first dollar-denominated Sharia-compliant loan to be issued by the South African government.
The objective with this type of bond is to, one, obviously diversify your funding sources, diversify your investor base. Secondly is to ensure that you set a benchmark for other issuers, because you don't want a situation where other issuers have no reference rate. And usually if a market is untapped, most people feel uncomfortable going into that market.
Sharia-compliant bonds are issued in accordance with Islamic laws. Such laws require that interest is not paid or earned and is based on a predetermined return.
Whatever instrument that is structured, it would then exclude interest. So in this particular instance, and obviously the maybe just to add on to that as well, besides interest, the uses of the money, you cannot use it for gambling, you cannot use it to invest in tobacco. So it has several prescriptions that when you are issuing a product, then you need to be abiding by.
The $500 million sovereign sukuk issue will be used to fund infrastructure development in South Africa. The bond was 4 times oversubscribed and was taken up mainly by investors in Asia and the Middle East, a clear shift from the foreign direct investment that usually flows in from the US and Europe.
There's a lot of money there in the Gulf countries and Malaysia and other places, but they want to invest according to certain principles. So now just opening up an entire new avenue for a new source of funding.
Islamic banking has been relatively foreign outside the Arab world, but that's starting to change, with more mainstream banks offering Sharia-compliant banking as an option to its Muslim and non-Muslim clients. Assets under management in the local banking sector are estimated to be over $8 billion. The South African sukuk bond issue has now paved the way for other African countries who have until now had much smaller Islamic bond issues in their local markets.
It at least focuses light to Africa, and everybody can start thinking about, what other opportunities they can take advantage of in Africa. And I must tell you, I think even from the Middle East investors' perspective, it gives them some geographic diversification as well.
Apart from investments, personal Islamic banking is estimated to be worth over $1 billion in South Africa and is expected to grow at least 10 times its current size in the next few years. Sumitra Naidu, CCTV, Johannesburg.
We're still keeping a very close eye on developments in the oil prices. Reuters have a fairly interesting report out today. September output was a little higher than August, 9.7 million barrels, but what they actually brought to market was 400,000 barrels less, about 9.36. We still have no idea exactly what OPEC will be doing on the November 27th meeting. We're keeping a close eye on that. We'll have the report on what they will do when it happens. Coming up next, we'll be looking at a mobile kiosk that's revolutionizing communication and energy consumption in Rwanda.
BizAsia. Asia means business.
Welcome back to the program. A Rwandan entrepreneur who sold his trucking business in the United States to move back to East Africa and begin the African Renewable Energy Distribution Company is making waves. Henry Nyakarudi's company, the African Renewable Energy Development, or ARED firm as it's known, has pioneered the development of a mobile solar kiosk. Now, simply put, it's a one-stop micro-retail outlet powered by solar tech with a backup battery system to boot. Tonight, we'll be exploring why ARED's franchise model is expanding very rapidly in Rwanda and Burundi in our Grassroots Business segment.
This is a more traditional kiosk, wooden-based kiosk, where people actually sell mostly one item, which is airtime. Sometimes they may sell cell phone. And what we're trying to bring in the market here in Rwanda is a more professional-looking system that generates its own electricity. And it has 2 solar panels, 40 watts each. They're all retractable that you can close. And as you can see here, we can charge actually twice as much cell phone as we can than the prior model. So we have stands where we can put cell phone, solar lights that people can sell agent. One of the key features of this kiosk is 2 drawers system that allow operator to keep its supply, even money, items that he found necessary that he can store here. And the last biggest change is the 3rd wheel. So it's a very, very simple system, cost effective, that was able to lower the cost of doing business because it generates its own electricity and it is mobile. So we adopted a franchise business model using a patent pending mobile solar kiosk. which will allow the operator or the franchisee to sell different type of products and services to the end user. And all this will be packaged as a one-stop shop kiosk. So the idea is to partner with co-ops or association. So we'll be training those individuals on several aspects, on how to be entrepreneurs, how to market themselves, how to use the kiosk. So the way we'll be generating revenue, it's a profit-sharing system. The key thing here is the business model. I truly believe that entrepreneurship is one of the solutions to solve poverty in the region. And not only that, based on my experience, entrepreneurship changed my life. So this model is not there to cater to everybody. We're truly looking for specific type of people. We're looking for individuals that understand business, that are looking to be in business, but they don't want to be in business by themselves. Right now in Rwanda, we have 4 kiosks, and we have 1 in Burundi. We charge roughly between 20 to 30 phones on a daily basis, and those are using the older model. The goal is to have about 400 kiosks just in Rwanda. So you're looking at 400 to 800 entrepreneurs generating revenue that will feed themselves and their immediate family. We develop a software technology that is in sync with the mobile solar kiosk. And the way we'll be expanding is to licensing the technology through royalty fees. So this is the global vision of this particular project. And of course, keep in mind that the kiosks keep evolving. And one of the key features we're going to add in the future, and I'm very, very excited about this, it's a Wi-Fi technology built in the kiosk. So people around the kiosk will be able to access the internet on a very, very low cost.
With regard to currencies, we're keeping a close eye on the Naira, of course, in regard to the fact that oil prices have dropped. Brent crude is down over 20% from its peaks in June, July, give or take. And the Naira, of course, did get a bit of support from the central bank. An undisclosed amount of dollars was sold in the market yesterday. Whether or not that will, of course, be sustainable moving forward is another matter altogether. Now, let's move a quick run through what we're working on for tomorrow's show. We'll be looking at the African Union's take on the economic crisis being caused by the Ebola epidemic right across West Africa. Ground zero is 3 countries. We'll also be getting an insider's perspective of the tourism industry in Zambia later on. But that's it for this edition of the program. Thank you so much for watching. You know the usual drill. Feedback to Global Business Africa at cctv.com. And when we're offline, the news continues to flow online, Facebook and Twitter are your ports of call. We'll see you over there. And of course, we'll see you in the next 23 hours as well. Goodbye.